Michigan, is it a lien or a deed state? Michigan is a tax deed state, and it's what they call a taking state. And we're going to show you how this is a big opportunity for you and your investors. In this video, you're going to discover how savvy tax deed investors are taking advantage of the fact that Michigan will do a lot of the work for you. We're going to show you how to walk through step by step through this whole process. There are three main things you want to be concerned about in Michigan, and we're going to cover every single one of these in the video. So stick around to the end. So here's a little known fact in Michigan. There are actually more lighthouses than counties, okay? But it still makes for an ample opportunity there. There's over 80 counties in Michigan. Now, Michigan is a deed state. What that means is that a property owner has to be delinquent for a minimum of 3 years before any legal action is taken on the property. In other words, the property owner has failed to pay taxes 3 years in a row. Once that happens, the county actually forecloses on the property. This is one of those unique things where the county literally almost does everything for you, kind of. Okay, there's still the research process and everything else that you're looking at there. So Michigan is a taking state. What does that mean? That means when the property owner fails to pay the property taxes over that 3-year period of time, the county will foreclose and take the property. They will literally go out there and take pictures of the property. If nobody's in the property, they'll inspect the property inside. And so you're literally seeing everything right there in front of you on the property. I was just recently at a Michigan sale where we saw everything on it. It was like, it's almost kind of a dream, if you will, because you're looking at it going, what didn't they give me? So everything is there for you in the state of Michigan. It's really nice. So Michigan is one of those unique places that is a deed state, but they're extremely efficient at it. That doesn't mean they all operate the same. Just like any other state out there, you've got to make sure you're crossing your T's and dotting your I's. For instance, when the list comes out, just because the county is foreclosing on it doesn't mean it's a desirable property. They have to do certain things by law. You do not. Okay, you need to follow the methods. Okay, first of all, what are your investment objectives here? What are you trying to accomplish? What are the best areas in town? So do your geographical best in that area. In other words, find out what the average price of a home is in that particular county so that you know that if you're looking at a piece of property, and let's say the average price of a home is $350,000, and you're looking at a $125,000 property, you're in a lower income area. Okay, if I'm looking at a $500,000 property, I'm in a much more affluent area. Again, looking at school districts, it's real easy to sit there and type in and say, what's the best school district in this particular county by zip code? So you're kind of matching that up. Affluent, better school district kind of go hand in hand. Also, economically, what's going on in that area that's driving the economy? There are some places in Michigan, no matter what they do, the economy has always struggled, okay? So values aren't gonna necessarily go up. Could be just a good rental market, which segues right into the next thing. What does your rental market look like in that particular area? Are there more rentals or are there more owners? And this is a really strange thing. For other people in other parts of the country, you don't always see that. So what I've found in some of these Midwestern areas, Pennsylvania, Michigan, Ohio, is certain neighborhoods are predominantly rental properties and certain areas are predominantly owner occupied, which is really interesting. I mean, I live in California and it's just whatever you want to do. That's a rental, that's an owner. So it's strange when you're looking at that. So you want to find out, in this neighborhood, are these predominantly rental properties or are they predominantly owner occupied? Because that will affect your exit strategy on this. So if I'm buying a piece of property, you could be having to sell it to an investor, which means you have to have cash flow on that in order to have any kind of value. That'll affect your exit strategy on this. So you want to make sure you have all of that. Here's another nice thing about Michigan. Michigan, once a property goes for sale, it goes into inventory and there is no minimum bid. Okay, so if you see something in inventory and you want to buy it, you can go ahead and make an offer on it and they just might take that. Okay, now remember, just because it didn't sell at the auction doesn't mean it's a bad property. It could have a minimum bid that's just too high. In other words, the property taxes were accumulated so high on this thing that the value of the property is here, the amount of taxes is over here. Here's another thing about Michigan that you need to know. They may have an online sale, but people can show up in person and also buy in person. Kind of what you would call a dual bidding state, if you will. We have dual states that have liens and deeds. There's a dual bidding state on that. So you can be in person or online. I don't know if there's any advantage to being there in person. I know, I like to be there in person. So now that you're going through these checklists, when you're going through the method, we're looking at the school districts, we're looking at values, make sure the value on that property is there. Right now, at this recording, the real estate market is precarious at best. I think the only thing that's holding values up is people have very low interest rates on properties, and they don't want to sell their property because if they do, they have to buy into the high interest rate. So what I'm saying, I'm giving you a cautionary note on values. When I'm looking at a value on a piece of property, I only want to go back a maximum of 45 to 60 days on sold properties. So if I have a 3-bedroom, 2-bath property that's 2,000 square feet, I want to find 3-bedroom, 2-bath properties at 3,000 square feet in that neighborhood that has sold. I want to repeat that. Has sold in the last 45 to 60 days, not is for sale. There's always these real estate investors go out there and say, you can't trust Zillow or Trilio or what have you. That's not true, okay? If it says sold, that's what it sold for, okay? You take how much the property sold, divide the square footage into that. That is your price per square feet, period. I don't care what anybody says or how they improve the property. This is where that term overbuilt for the neighborhood comes in. When they say overbuilt for the neighborhood, that means they put too much into the property, and irregardless of how much they put into the property, it's still only worth $200 a square foot, $225, $190, $300, whatever that is. So they could have put gold leaf trim around it and spent $50,000 doing that. The property is still worth what it's worth. And how you're going to get that value is through your comparable sales. In other words, like I said, what has sold in the area in that particular area. Property values on that. Then you want to look at rents. What are rents in the area? Is this a rental market or is this a owner-occupied market? That'll determine your exit strategy. Now, something very important to understand with this. It's not just a buy, fix, and flip market when it comes to tax liens and tax deeds. It's a buy and let the property tell you what to do. So if I've got a $250,000 property that I get for $50,000 in back taxes, and I can rent that thing out for $2,500 a month, it's kind of telling me to rent it out, okay? Because if I sell that property, what's the number one thing I'm faced with? Capital gains right off the bat. So remember, it's not one or the other. I'm just telling you, be aware. When you're selling properties, you're making money. When you're keeping properties, you're building wealth. If I've got a $250,000 property that I paid $50,000 for and I'm renting out for $2,500 a month, okay, I'm building wealth because I can still pull the cash out of that property, go do another deal, but not pay any capital gains because it's borrowed money on that. So there's many factors that you want to look in. Just because a county or a state does a lot of the work for you, all of the things that we look at when evaluating whether to do a deal or not still need to be considered. Without those, you're going to fall flat on your face. Okay, there's a lot out there and we will walk you step by step through that process. All you have to do is go to higginsmethod.com, click and fill out the information there before, and I'll get one of my experts to call you up and walk you through that very process. God bless and good luck.